We've heard about the infrastructure that not only is necessary to link our buildings together, but also provides the quality of life that attracts so many of us to urban living and to the city. But of course, it all comes down to who's going to pay for this, right? So how do we actually finance these improvements? How do we finance these technologies? How do we finance the energy retrofits that are necessary to make the building stock in New York City and in other similar cities more sustainable, more competitive? So we haven't seen too much investment and finance actually flowing into these areas at this point. There seems to be some strong disconnects between what we know to be the potential energy savings and other efficiencies from, say, doing a building energy retrofit or investing in a more sustainable property. But largely, the investment and finance community is staying away from this. And I think there's a lot of uncertainty, a lot of risks still out there that's providing a lot of the constraints that we're seeing. I'm really honored to share the stage with such an incredible panel this afternoon, or this morning, I should say. These are the people who are really kind of shaping what the finance and investment community are doing in terms of sustainable properties and in terms of financing for energy retrofits. From the research side all the way to kind of financing the actual retrofits, to providing the tools for how do we underwrite and value these buildings, to actually investing in sustainable and socially equitable properties. So I would like to begin how we're going to handle this. Of course, we've asked each one to introduce themselves for about 5 minutes. I'm going to ask that it is a 3-minute 5 minutes rather than a 7-minute 5 minutes, so we have plenty of time for questions. And I'll just briefly introduce everyone and then allow them to come up in turn. And again, you have their bios in the book, so I'll be brief. I'll start just to my left. Of course, Professor Franz Furst, Associate Professor of Real Estate Economics at the University of Reading, which is just outside of London in England. Previous posts have included a research associate at the City University of New York and a lecturer at TU Berlin and a senior consultant at BNP Paribas. He holds a Master of Science in Spatial Planning and a PhD in Economics. I have to say that Franz's bio in the book is very, very modest, probably way too modest. He's done some just exceptional research on looking at the price premiums and rental impacts and other economic impacts of green buildings. Occupancy issues and all of that, and valuation issues. So it's an honor to have him here, and we're working on some interesting research now. Also coming from across the pond is Dr. Ingo Holtz. Ingo is managing partner of BEOS in Berlin. It's an independent investor, developer, and asset manager with 42 offices in Berlin, Hamburg, Cologne, and Frankfurt. Presently, they have a portfolio of 20 properties with a net leasable area of 8.2 million square feet. That encompasses not only Germany, but also Switzerland and Belgium. Recently, they've launched an institutional fund with a volume of 400 million euros for real estate investments in Germany, which just started in October 2010, and they're launching a second of a similar size now. He's also an assistant professor at the TU Berlin and has taught here with us at SHAC, and we run a fantastic collaboration with Ingo that was set up by Professor Tom Gertz many years back, so we have a nice ongoing relationship here as well. Sam Marks is vice president of Deutsche Bank Americas Foundation and the bank's Community Development Finance Group. These two entities work in tandem to deploy the full range of the bank's social investment resources towards benefiting low and moderate income communities, including grants, program-related investments, loans, and equity investments. Sam focuses on affordable housing, community economic development, education, and the intersection, most importantly for this topic, I think, of energy efficiency in the built environment in New York City and throughout the U.S. and abroad as well. Before Deutsche Bank, he was the director of housing and community development at WHED Co. in the Bronx, and before that founded Breakthrough New York, an academic enrichment program for motivated middle school students in New York City. To his left is Scott Moldavan, executive director of the Green Building Finance Consortium, and Scott has been dealing with kind of green building finance from the very beginning, before people were actually talking about green building and the connection to finance in any meaningful way. His work, I think most of you have probably seen this, is a recent text called Valuing Beyond Cost Savings, How to Underwrite Sustainable Properties, which is the first to address the identification, pricing, and mitigation of risk that is key to sustainable finance. His many other sustainable activities include advising the Zero Energy Commercial Building Consortium and the U.S. Department of State, Mr. Moldavan has led the Moldavan Company for over 10 years, been a lead real estate partner at Deloitte & Touche, co-founded Guggenheim Real Estate, a $3 billion private real estate company, and served on the advisory board of Global Real Analytics, and an advisor to $2 billion of REIT and CMBS funds. And last, of course, but not least, Wendy Roden is Managing Director of Investments for Jonathan Rose Companies. In that capacity, leads their investment practice, drawing on her 25 years of experience in the real estate industry. She really has responsibility for all aspects of the firm's fund business, including oversight of acquisitions, financing, asset management, and investor relations. Ms. Roden is a past president of WX and a former member of the board of directors and executive committee of Cushman & Wakefield and Safe Space, New York City. So with that, I would like to call Franz to the stage and have him do his presentation, and we'll go in order from there and then take questions. Thank you. They're all down here.
All right. Hello, everyone. I would just like to reiterate some of the key benefits that are related to sustainability and green buildings in particular. And I think most of these you'll be familiar with, but maybe provide a good starting point for the discussion later on. So basically, and I think this is also one of the biggest obstacles to more green investments, really is how to link sustainable features to the financial details and the economic benefits. So this is sort of a first attempt to group these benefits and linking sustainable features to actually financial benefits. And basically, they can be divided up in three groups that are, of course, interlinked. First one being cash flow related. So higher rents, potentially, higher occupancy rates, higher tenant productivity, higher tenant satisfaction. You'll note I put a question mark behind all these because that's basically our research agenda as academics, to study each of these benefits, provide empirical evidence that they're really there, try to look for as much evidence as possible in all different kinds of ways, different countries, different data sets, different models, really attack the issue from all sides and hopefully come up with a really robust conclusion as to what actually, well, first of all, is there green value? And then the second question attached to it, what's sort of the magnitude of the premium, of the green value that's added. Secondly, holding costs related benefits, hypothesized at least, and also some empirical evidence for it. Lower operating expenses, lower maintenance costs, lower insurance costs, lower energy price exposure. And thirdly, the value component, obviously also strongly related to the other two. Higher prices, lower risk, potentially lower cap rates, slower loss of value, lower risk of obsolescence, and very important component, obviously, the financing conditions and tax incentives that I think we're going to discuss today. So, as I said, there are question marks behind some of these benefits, and just on a sort of a priori basis, there are grounds to expect a number of these benefits that will translate into a premium for assets with superior environmental performance, whether they are certified, LEED certified, Energy Star certified, or just exhibit superior environmental performance per se. So our studies that we've been done at the University of Reading with my co-author, Pat McAllister, a few others, we do find empirical evidence for some of these benefits. A couple of other researchers have looked at it, John Quigley, for example, who's the luncheon speaker today. I'm looking forward to his talk, together with the co-authors Niels Koch and Pete Eichholz. Some other colleagues have looked at outside of the US, places like Japan. We've also just started a study in the UK. It took us a while to get the data together, but we also find at least some evidence for BREEAM-rated buildings, but it's very preliminary. So our main field of research is in the US, and there we are pretty confident that there are these benefits, in particular rents and prices. So if these benefits really are there, why don't we see more green lending, more investment in real estate? And basically, here are some key points I think that matter in terms of explaining why there is currently not more investment. First one being there is a potential triple market failure here at place that prevents, sort of puts up barriers to more investment. The first one, and this is basically environmental economics 101, negative externalities of emissions. So in a setting where the polluter doesn't have to doesn't have to bear the cost of cleaning up, obviously there is no incentive for cleaning up your act if it's basically externalized. The other one being positive externalities of green technology, sort of reversing the argument where investing in green technology creates a lot of positive externalities, which means they're still not incorporated in the price. So the first innovator basically incurs a high cost, takes on a lot of risk to see whether it actually happens, creates spillovers for others who will follow and invest, also bringing down their own emissions and pollutions, of course, and thereby we've got a second market failure. And the third one lies simply in the adoption externalities, which are basically goes back to that old joke that says the first person who bought a phone more than 100 years ago, it wasn't useful at all because it couldn't call anything, it couldn't call anyone. And it's similar maybe to green investments, where the more green investments you see, obviously, the more momentum there is, the more knowledge there is, and the whole question of knowledge base in the local economy and also globally. Information problems, of course, is this link between environmental and financial performance real? It's still not well understood. We're trying our best, so to speak, from an academic point of view, looking at large studies, large samples, and trying to establish this link. But obviously there is also apart from that top-down component, there is also the bottom-up, looking at the individual asset and actually translating these benefits to the asset level. Then the known problem of split incentives, especially a problem in rental markets, because the one who invests in green technology, the owner or landlord, may not be the one who's reaping the benefits, which would be the tenant, obviously, getting lower energy bills. So there are a couple of ways to deal with it, and I think we're going to discuss that today. Doubts about the actual reduction potential. So green by design doesn't always maybe translate into lower energy consumption. There are some issues there that may also cause sort of a barrier. And still uncertainty about the financial specifics of certain deals, whether they're government initiated or private sector, so pertaining to collateral, seniority of debt, and so on. So devil's in the detail, although it may be sound like a great idea, some of these initiatives that were put forward. Devil's in the detail. And also, I think a lot of behavioral barriers that play a crucial role. So focusing on a short term rather than the long term certainly doesn't help green investments, or attitudes like it's not broken, why fix it, or the sheer invisibility of the product. So you can't actually see energy efficient, usually, at least to the untrained eye, you can't see energy efficient or a green building from the outside necessarily. And I think that's also why labels, as much criticism there has been on labeling and focusing on labels, I think labels have a very crucial role to play, exactly because of the invisibility issue that is at the heart of this. So just to finish off quickly, in terms of the public sector and the public sector's role, basically it's a multiple role that the public sector can play as innovator, investor, guarantor, and user. Basically, that's sort of a key, or a number of key roles that the public sector can play, be it in government initiatives such as Better Buildings in the US that's currently unfolding and being developed, or the so-called Green Deal in the UK that are very similar with some important differences in details. But basically, these initiatives have the potential for resolving the payback period risk, basically a large upfront investment cost that, especially if you're in for the short and medium run, you might not be able to recoup during that period. And the difficulty, of course, from the public sector of determining the optimal levels of incentives and regulations to internalize externalities. There's so many initiatives going on, bottom up, top down, cap and trade, tax, incentives, all kinds of things, and obviously to coordinate these and reach the optimal level is quite a difficult task, if not impossible. And finally, for the commercial rental markets in particular, I think it's quite an extra challenge, so to speak, because the success of all these initiatives will depend crucially on arrangement to incentivize all concerned parties. So it's not just enough that lenders, investors, landlords, or tenants have individual benefits, but actually create a package that incentivizes all of them to sort of break through that stalemate. But I think a lot of these issues are being resolved at the moment, and lots of initiatives being put forward. So I'll leave it with that.
Thanks, Konstantin, for inviting me over to be part of this great conference. He just asked me a couple of short notice, so to say, to change to this panel from Jim's panel. So it might happen that I'm rather the 3-minute introduction than the 5-minute introduction, but anyway. I'm from Berlin, and maybe that helps us to give some international aspects on how we view green building industry, and to have this as a further exchange and discussion thereafter. I would like to concentrate on 3 theses that I basically envisaged for the short to midterm development of sustainable buildings. 1, the real estate industry needs a clear picture and concept of the requirements. 2, the real estate development market is envisaging a prosperous decade. And 3, the tenant will remain cost and budget driven. Maybe that's the aspect I want to point out at the end. We heard from Robert Fox in the beginning about new buildings, and I have to say new buildings also in Germany have a clear regulatory of green measurements that have to be constructed into the building and requirements that have to be met. However, the new building market in Germany is at around 1% of the real estate market, overall market in Germany. So if we talk about new buildings, we're just talking about a fragment of buildings. And if we're talking about the top CBD buildings that Bob Fox was alluding to, it's even a fragment of 1%. So more from a real estate developer perspective, it's more important also to look at the refurbishments and the retrofits of existing buildings. And that's exactly where real estate industry needs a reliable set of requirements that, if you compare it a little bit to the automotive industry, where the enforcement of catalysts into the industry basically was something after which, in a very short time frame, the automotive industry changed and was able to provide that kind of a measure. And that given, and if we remember back, it was the top Mercedes, Porsche, and BMW, and what other international brands that started off with that kind of introduction of catalysts, and then it boiled down to all kind of different cars. That is exactly what I envisage in our industry, also in the existing buildings. The German government has released an ordinance of energy saving in buildings, abbreviated ENEV, which is updating every second year. So every second year, the government releases a new set of measures on what green measures have to be introduced in new buildings and also in existing buildings for refurbishments, etc. On one hand, it gives clarity of what a government is expecting. On the other hand, it gives also uncertainty because, as we have learned and Franz pointed out, it's all a question at the end of the day of the rate of return that you envisage for such investments. And the half-life of such measures is getting shorter and shorter over time. So even if the government releases a new ordinance, it's unclear if 2 years later there's one even overtaking the first one. So that uncertainty, especially in retrofits and refurbishments, is clearly giving also uncertainty to the investors, which as a reaction think about when the ideal timing is to invest into green measures of existing buildings. We may not forget that such investments are not increasing the net rent. Such investments, not at the instance, such investments help to reduce the additional costs and the service charges. So the return of investment from an investor's point of view who's owning the building is really difficult to calculate, because if you invest into something and you don't see more rent at the time of investment, maybe after some time, but not instantly after the time of investment, because the law of gravity is simply the market, and if the market has a whatever level, say 10 euros per square meter level, it will not increase to 12 euros per square meter just because you've taken measures of investing into the green building. You have reduced potentially the service charges and additional costs, but then again, exactly those costs are the ones which constantly keep increasing. So that is a matter of time. The second thesis I had was the real estate developers envisaging a prosperous decade. I am a real estate developer, so that was obvious. I was going to make this proposition. However, the half-life, and I was saying already, the half-life of substance value of real estate will be less in this dynamic environment. To give an example, if you're buying into a building today and you have it for 10 years, after those 10 years, research shows that as an investor, you have to invest about 25% into the building to keep it at the level of which you bought it at 10 years before. That is a complete new way to think about real estate, also from a institutional investor perspective, which only see the value upwards only scenario. And here is the scenario which after 10 years clearly takes a ditch with two possible reactions, either the net rent thereafter going further down or reinvestments that have to be incurred to keep it at the very same level. So that is one of the, and for me it's the comparison in that respect before we had the automotive industry. Here is the computer industry, where also the half-life of a computer is getting less over time, and the same is going to happen in an industry that has such a dynamic, like the green industry and like the industry in creating energy, good energy figures for your building. The dynamic of the standards are released on a regular basis, as I said, and terms that come into age will lead to such tenants have a broad variety of chances after a lease has expired. And we recognize in Germany that the tenants are becoming more and more mobile. So whereas before tenants were kind of stubborn in a location, if just across the street there's a complete new build, asking for, again, market prices don't change just because of the green building status. So if the new build is at the same level of your 10-year aged building, you really have to have a clear picture of what you do to keep the tenant or to allow for less income thereafter. The certificates of green buildings, we've heard about silver standard, gold standard, platinum standard, for me is a very costive marketing tool. I don't think it has really a great effect on the industry. And especially if you take, for instance, I may say, Sam, I was also working for Deutsche Bank Real Estate before in Germany. They have just invested a triple million amount into their headquarters, which is kind of the two towers in Frankfurt. They created a platinum standard in Germany, which didn't exist before. The standard ended at the gold standard. So just imagine that building. One, Deutsche Bank really bought themselves into the image of being the greenest of all green banks. That said, it's only the headquarter which is in such a high standard level building. All other Deutsche Bank, if you take the Berlin office, if you take other offices, they're in usual standard buildings, except for the headquarter. The London building, which is even economically more important to Deutsche Bank than Frankfurt, is also in a standard certified building compared to the headquarters with a platinum building. So it's a marketing tool. From the owner's perspective, that marketing tool leads to, again, 10 years in time, what happens to this platinum standard if there are other standards in the meantime that have overtaken. You have to invest tons of money to keep that standard alive. Last but not least, the third thesis I was going to concentrate on is that the tenants will remain cost and budget driven. It's only, again, a very limited tenant market out there which specifically looks for high-end green building standards. This is great concerns, and it's global partnership companies. If you take the middle-sized companies in Germany, which make up for more than 85% of the German economy, they don't care about certified buildings in green standard. They care about low service charges and additional costs, and they're budget-driven. So for them, it is more important to have a clear picture of their costs going forward, and not that much of buying themselves into an image they can touch, because years later it's most probably gone. Even though investments into green standards don't boost the net rent of a building, what it does is it helps to increase the value of a project as you want to sell it. That's kind of what we have experienced. So it's not that much in increasing the net rent, but in lowering the cap. But it puts the risk to the investor and the real estate developer. It's not basically what you can see while investing that you increase your income at the same time. It's deferred, and hopefully you see more value as you sell it. Thank you very much.
Thanks all for your patience. And thanks, Constantine, for having me here today. So I wanted to give a community development perspective on this question of smart finance. And I think the community development perspective is a unique one in this room. As Constantine mentioned, I represent the Community Development Finance Group in the Deutsche Bank Americas Foundation, and we're the area of the bank that's responsible for the bank's obligations under the Community Reinvestment Act, which was banking legislation to require banks to lend and invest in low and moderate income communities. And our catchment area is here in New York City. We have a particular focus on affordable housing and multifamily housing. And we've got an investment portfolio of about $480 million in loans and investments directed to that sector, as well as grants and philanthropic lending that we use to try to be catalytic in bringing innovation to the sector. And I think what's kind of unique about this perspective is that it's got a sort of public-private sector partnership model baked into it. When you think about what the South Bronx looked like in the 1970s when the CRA, Community Reinvestment Act, was passed, it had suffered from years of disinvestment and neglect, and there were large swaths of the neighborhood that were vacant and really distressed. And that was true in East New York and other neighborhoods in New York City and other urban areas around the country. And what CRA did was create a whole infrastructure around making transactions happen to improve these neighborhoods. So it was public policy in individual cities. It was a whole set of nonprofit intermediaries that sprang up to help banks like Deutsche Bank and Citi and JP Morgan find responsible ways to invest in those neighborhoods. There's just been a huge volume of transactions that have happened to improve those neighborhoods. And when we think about climate change, we think about the issue of the environment and all the negative externalities that Ian mentioned, we think about this public-private partnership model as a way to help those kind of transactions happen. So energy efficiency in buildings is one of those areas where our environmental aspirations around climate change and carbon reduction should align with finance, right? I mean, we've got catastrophic waste in buildings, particularly, not in the in the Bank of America building, but in Class B office buildings and sort of mom and pop multifamily buildings. We've all driven by neighborhoods where people are keeping their windows open, during the winter time. So there's catastrophic waste there that should be able to be monetized. Someone should be able to figure out how to lower energy use, increase cash flow. And are you guys familiar with that McKinsey cost curve of greenhouse gas abatement? I would have shown it, but they told me only 3 slides, so I didn't bring it up. But it talks about all these different greenhouse gas reduction strategies and what their costs look like over the long term. And all of the stuff around building energy efficiency is on the negative cost side. In other words, these are all things that should be able to pay for themselves. So efficient boilers, insulation, all these simple cost-effective strategies. But those transactions aren't happening at the scale that we'd like to see. My next slide is going to be like the main content of this. But to set it up, I want to say that I swiped it. I always steal from the best. This is from a set of research that was funded by the Kresge Foundation as a part of a funding collaborative called Living Cities, which Deutsche Bank is a member of. And it's a consortium of banks and foundations that came out of the community development, public-private sector partnership mindset and are working to think about how better kind of alignment can happen. So what I'm going to show is some research from John Cleveland, who was funded by the Kresge Foundation to take a look at this. And these are sort of the key retrofit barriers in the marketplace, both on supply, demand, and then they include another issue around exchange. So it's a low-margin business. We're in a lot of multifamily buildings, which is mostly what we care about. We're talking about achieving 20% or better savings. In the overall scheme of a building's operating, that 20% of savings on energy is going to be a small percentage of the overall operating costs. We're talking about a lot of small transactions needing to happen. At Deutsche Bank, in the business lines, they don't look at something unless it's in the hundreds of millions. And we're needing to aggregate demand from a lot of different kinds of buildings. There's some labor scarcity. Seems crazy to say when there's so much unemployment. There are certainly lots of construction guys on the bench waiting to come off. But in terms of having the kind of skilled labor that you need that can create this kind of seamless delivery system, there's some scarcity there. New business models. I think we're seeing a lot of kind of interesting finance companies that are kind of like ESCOs that are taking things to the next level. But we need to see more of that, and we need to see larger kinds of market segments that they're interested in. In terms of exchange, there's high transaction costs in terms of getting an auditor, and there's a lot of transaction costs that make it difficult to do. Hard to assess the competence and quality of those auditors as well as the contractors who do the work. Multiple vendors required. High effort relative to the cost and to the benefit. Then on the demand side, consumers have other priorities. They may want a new lobby rather than a new boiler. This is one we're really interested in focusing on. There are limited metrics to measure the savings and translate that into cash flow. The value is not reflected in equity. That should probably say seemingly. There can theoretically be ways that we make energy improvements more transparent, and the better buildings, or greener, greater buildings legislation here in the city aims to do that. It's unaffordable for some segments, and the financing can be complicated. So these are a lot of hurdles that need to be jumped over in order to get a more routinized marketplace around these energy efficiency transactions. I was trying to get off in 5 minutes, so I'm just going to mention a few things that we're involved in that I'm hoping we can come back to in the question and answer section. Just briefly, Community Preservation Corporation is one of these nonprofit intermediaries that helps banks like Deutsche Bank and others aggregate their capital and deploy it to